Well, sorry that I had to pull you guys out of potentially long weekend, 5 days. Well, unfortunately, I had to sneak in between. Right? But having said that, we are also running out of time, and there's quite a bit to cover. So rather than rushing things towards the end, we might as well phase things out so that you all understand the contents a lot better, right? We can go at an easy pace now, so that you all have a basic understanding of the subject matter, right? Can you all hear me, by the way?
Can hear, sir.
Okay. Right. So we to discuss foreign exchange. How many of you have done foreign exchange before? How many of you have had an exposure to foreign exchange? Previous experience with foreign exchange? Well, how many of you have never done foreign exchange? Yeah. So I believe all of you are thorough with foreign exchange. Hello. Can I assume that all of you are very thorough with foreign exchange? Yeah. Yes or no? Hello. Can you all hear me? Okay. Right. So should I skip the basics and can I start from somewhere in between? Or you want me to cover the basics also? Yeah. Should I cover the basics or can I skip the basics? All right. How many of you have never done a foreign exchange transaction? Just to have an understanding of where I should pitch. Yeah. How many of you have never done foreign exchange? Hmm? Anyone who has never done foreign exchange? No? So all of you have done foreign exchange? How many of you have done at least a little bit of foreign exchange? At least a little bit. No one has done. Nothing, no one has done. I need you all to answer. Guys, if you are not interested, we can stop, right? Just tell me whether you have done or have not done foreign exchange. Never done, or have you done a little bit? Well, if you are not willing to communicate, we can stop the class, right? Okay. Right. Just make it interactive, otherwise I'll fall asleep, right? Well, the point is, if you know to buy a pen, right, then you know foreign exchange. Simple as that. Now, I assume that all of you can buy not only a pen, even a loaf of bread, right? If you know to buy a loaf of bread, it's no different to foreign exchange. Both are the same. It's just that you have dollars and euros and all those in your mind, and you think it's very complicated. So you get confused, right? But that need not happen. If you know to buy a loaf of bread, if you know to buy a pen, if you know to buy anything under the sun, then you know foreign exchange, right? All you have to do is, instead of a pen, you will substitute a currency. That's it. Or if you know to buy a mango, that's also foreign exchange. There is absolutely no difference. Okay. Now, for example, if I say that one red pen is 100 rupees and one blue pen is 200 rupees. Right? Which one is more expensive? The red pen or the blue pen? Very simple. So how much is one blue pen in terms of red pens? In other words, this is the red. Pen to LKR exchange rate. Right? This is the blue pen to LKR exchange rate. So how much is one blue pen in terms of red pens? You obviously know that the blue pen is more expensive. So one blue pen should be more than one red pen. No? So one blue pen is equal to 2 red. Simple, no? So this is foreign exchange. There is nothing new to learn. Okay. Now, if I may ask another question, why can't the entire world use one currency? Something that always gets kept me thinking, right? Why doesn't the whole world use one currency instead of using their own currency? Why not one currency for the entire world? What do you think? Why can't the whole world use one currency? What do you think? Why can't the whole world use one currency? Very good. Economic strengths are different. Right? So if the whole world was using the US dollar, now that is my question. Why can't the whole world use one currency? Maybe the US dollar, right? Or the Chinese yuan, or the Sri Lankan rupee. Why not? One good reason is the economic strengths of different countries. Wait. So with economic strength comes things like monetary policy independence. Yeah? Which means now a country can print its own currency. So the Sri Lankan government can print rupees. The US government can print dollars. But the Sri Lankan government cannot print dollars, and the US government cannot print rupees. And so the US is fortunate that they can print the world's reserve currency. So if they run out of currencies or cash, no problem at all. The US can still print money, which is not a luxury that most other countries have. They don't have the capacity to print the reserve currency of the world, right? Which is a luxury that only the US has. Now, that is called printing money, monetary policy, isn't it? Increasing the money supply. Right? If you increase the money supply, you can control dynamic things like interest rates, right? And to certain exchange rates. You lose all that independence if the whole world was using one single currency. Classic example is Greece. Now, Greece defaulted on euro bonds, right? The reason is at that time, Greece was part of the countries that are using the euro. Right? So they are not allowed to print euro. The euro printing can only be done by the European Central Bank. And so Greece lost its ability to print. They couldn't settle their obligations and they defaulted. And so you lose monetary policy independence. Very good point. What else? Why can't the whole world use one currency? If that was the case, we don't have to do a separate topic called foreign exchange, no? Right? Because the foreign exchange rate, every country is using foreign exchange as the same currency. There is no such thing as foreign exchange, right? This will become a non-existent subject. Well, actually, the world is getting there right now. Look at Bitcoin, cryptocurrencies, right? Whether you trade Bitcoin in Sri Lanka or you go to the US and trade, or in India, some Singapore, wherever you go in the world, a Bitcoin is a Bitcoin. Right? So if you go to an exchange which accepts Bitcoin, you can pay in Bitcoins. Right? Now, in that case, it is not foreign exchange. Foreign exchange rates apply when you convert from Bitcoins to other currencies. But across the world, you use the same currency. Okay, so it bypasses all regulatory bodies. It doesn't have to go through central banks. There is no exchange rate. So if there is money laundering, it can also be done using Bitcoins, right? So there is an increasing trend towards Bitcoins. And that's one important thing. Then what about things like political views, right? Okay. So if the whole world was asked to use US dollars, right? Countries like China, Venezuela might not be willing to use US dollars, right? Or even Russia. Just imagine Russia using the US dollar. Will never happen. For political reasons, the whole world will not use the same currency. Okay. So unfortunately, for these reasons, the entire world is not using the same currency, meaning we have no choice but to do foreign exchange. We have to learn. Right? Clear? Any questions after that? Well, the point that Dinesh made on economic strengths. Now, there is a country which ultimately had to abandon its own currency. Right? It's like abandoning your own child. That currency is not used anymore. They had no choice but to give it up, and they are now using proxies for that currency. The US dollar is one proxy. What is this currency? Or what is the country that had to abandon its own currency? Yeah. Which country had to abandon its own currency? Not Greece. Actually, Greece used a currency called drachma, and when the euro came, the drachma had to be dropped, right? So it's not only Greece, but even countries like Italy, Spain, France, all of these countries gave up on their own currency and converted into euros. But it was actually an economic crisis that caused the country that I am referring to abandon their currency. Right? They had no choice but to abandon. Not Argentina. Right? Argentina defaulted on their debt, you're right, but they still have their own currency. Argentina, I think it's a peso. Dinesh, you're right, Zimbabwe, it's Zimbabwe. Okay, the Zimbabwe had to give up on their own currency. Why? What do you think was the Zimbabwe dollar exchange rate when it was abandoned? The US dollar, Zimbabwe dollar exchange rate. What was the exchange rate? Any idea? Any guesses? Very good, a million. And it was actually not a million, it was 35, right? 35, not just 35, but 35,000. Okay. Well, actually, it's not 35,000, it was, you're right in millions, 35 million. But it didn't stop there, it then went to 35 billion. Right? A little bit more, 35 trillion, and then a little more, 35 quadrillion. Okay, so that's where the Zimbabwe dollar ended up at an exchange rate of 35 quadrillion. This is 15 zeros, right? Yeah, 15 zeros, 35 quadrillion. Right? Now, this is actually when the currency strengthened. It went to an all-time low of 15, then 18, 21, 23 zeros. Then it strengthened a bit and ended up at 35 quadrillion. Which is not sustainable at all. Right. Now, just imagine a person who lives 100 years. Right. The person lives for 100 years. Every second, from the moment he is born, right, every second if he counts 1, 2, 3, likewise every second if he counts, he does nothing else but counts, right? Throughout his 100 years of lifespan, if he keeps counting every second, how much do you think he'll get to? So 60 seconds, 60 minutes, it's 1 hour, then you get 60 seconds is 1 minute, right? And 60 minutes is an hour, 24 hours, 365 days. How much is this? Yes, right, which is 3 billion, right? So he still falls short of Zimbabwe dollar 35 quadrillion. Now, if he is to get to 35 quadrillion, how many lifetimes, and how many lifetimes of 100 years each does he need? It's 35 quadrillion. Quadrillion. But for simplicity, let's say this is 3.5 billion. That's about 10 million, isn't it? So this guy, one person will need about 10 million lifetimes to get to 35 quadrillion. And if he counts every second, 10 million lifetimes of 100 years. Sorry, more than 100 years. Maybe 120 or 150 years. Maybe 120 years. At about 110 years lifetimes, it needs 10 million to get 35 quadrillion. Right? So that's what happened to Zimbabwe. 35 quadrillion. Imagine you get 35 quadrillion in coins. How on earth can you count them? No chance. Right? And how can you transport a quadrillion coins or even notes from one place to another place? How can you put that in an ATM? Or how can you, well, if a branch runs short of cash, how can you do the cash transfer? So many problems. Now, if you want to buy a loaf of bread which costs you $1, let's say $1 equivalent, you'll have to carry 35 quadrillion. How can you do it? Not even Superman can do it. Isn't it? Which is not sustainable. Well, actually, in Zimbabwe, you can take currency in wheelbarrows. They sell currency on the streets. No one is buying. Right? Toilet paper is worth a lot more. No one wants the currency. So why did it happen? What went wrong in Zimbabwe? In fact, the easiest way, right, to become not a billionaire. Now, today, I think there was an article, or even recently there were articles that Elon Musk has taken over as the world's richest person from Jeff Bezos, right? So the guy running Tesla is now richer than the fellow running Amazon. Now, well, actually, the most important thing about these comparisons, the measure of wealth is not how much of cash you have. No, they don't go and count how much money Elon Musk has in his bank account, or how much money does Warren Buffett has in his bank account, how much money does Jeff Bezos has in his bank account. No one cares. Bill Gates, nobody goes to his bank account and checks. What they do is they calculate their wealth in terms of the amount of shares that they have. Right? How much of equity have they got under their name? So when the price of the share goes up, their wealth also increases. Right? So it's, remember, you put money in a bank, you will never become rich. Isn't it? So money in the bank is not going to make you rich, not going to get you anywhere. You have to invest in growth stocks. Right? So that's why they have invested in Amazon, in Tesla, in Facebook, in Berkshire Hathaway. Right? Because wealth, that's what brings you the wealth. Nothing else. Not the money in your bank. Which is very exactly why you need to invest in value. Right? Value shares most of the time. And when you invest in shares, don't expect one night stands. Right? If you don't buy today, do a day trade and exit. You need to take a long-term view and invest. That is how you can extract the maximum value out of investments. Right? Okay. Right. Now coming back to this. This was a disaster. Economic disaster. What went wrong? How can you get to this really pathetic situation? How can you get to that? What led to it? What caused this? Well, it was actually hyperinflation in Zimbabwe, right? And excessive money printing and all that, which again led to hyperinflation. It was actually a vicious cycle. A vicious cycle, vicious economic cycle that led to this. Okay. Well, it's actually hyperinflation. The Zimbabwe government, Zimbabwe mostly imports, everything they consume is imported. So to keep inflation down, the government prints money, increases money supply, and with that interest rates come down, right? So then consumption increases more. When consumption goes up, they import, right? Because most of the stuff they consume are imported. So that when you import, the price and the demand for currency goes up, right? The exchange rate goes up. And when the exchange rate goes up, it drives inflation also, right? When inflation goes up, again, the government would print money. And so that led to a vicious cycle, which is what happened to Zimbabwe. Okay. Right, so that's about currency. Any questions up to now? All right, so let's move on. So the foreign exchange market, we all know, is where one currency is exchanged with another currency, right? Why do we need foreign exchange? Well, if we are doing any transaction with another country, we definitely need foreign exchange. Unless, well, even if we are US, right? If Sri Lanka is also US, we will still need foreign exchange because we'll also be dealing with all other countries, right? So international trade happens in foreign exchange, foreign currencies. Investments in other countries happen in foreign currency. Then now investing in even things like bitcoins or trading, like currency trading, happens in foreign currency. Yeah, for these reasons, foreign exchange is important. When a country buys goods and services or invests in another country, that country has to obtain some of the country's currency to make the transaction. The structure of the foreign exchange market, it is around the clock. Around the clock. It's almost 24 hours. It doesn't work during weekends, but 24 into the weekdays. There is no central location, right? Well, there is no head office for foreign exchange. It happens in various centers. Over-the-counter market, it's like buying a loaf of bread. You can buy the exact amount you need. Now, for example, if you want to travel overseas, you can go to a bank and buy maybe $500, $5,000, or $10,000, or any amount that you want, right? Because it's a over-the-counter market. liquidity is very high. Meaning, you know what liquidity is, right? It's the convertibility of an asset into another asset. Foreign exchange liquidity is very high. Having said that, right, the Sri Lankan foreign exchange market on a good day, right, on a good day, is about $100 million. The Sri Lankan foreign exchange market is about $100 million a day market. $100 million a day, right? That's the Sri Lankan foreign exchange market. Whereas the global foreign exchange market is about $5.3 trillion a day. So if you put this in millions, our contribution to the global foreign exchange market is about that much, which is very small, extremely small. Right? It's almost like a rounding off error, isn't it? Negligible. Right? So in the market, because the market is small, sometimes it doesn't make sense for foreigners to come and invest. Because even if foreigner comes and invests, and even if they get 100% of the foreign exchange market, their market share will only be 0.002% of the global market. Right? So to make this bigger, we have to make the foreign exchange market bigger. We have to expand and give more options for foreign investors to come and invest in. Right? So that is why the port city and all are coming up. So these are very crucial developments. The foreign exchange market is the largest financial market in the world, right? One of the biggest markets in the world. Daily turnover is about $5.3 trillion a day. Right. So these are the major centers in the world. Right? Now, foreign exchange market operates during different time zones, and the market is mostly active during UK time. And about 40% of transactions happen during UK time. That is because the UK time coincides with most of the centers. At the tail end of Japan, half the time of US, Dubai, Singapore, Hong Kong, all of those coincide at some point with UK. So UK is the major. During UK time only, most of the transactions occur. And these are the G7 currencies, right? Or the main currencies. Okay, and the participants in a foreign exchange transaction can be importers and exporters, right? So exporters are the guys who bring in the foreign exchange into the country. They bring in foreign exchange into a country, whereas importers take foreign exchange out of the country. Exporters bring in foreign exchange, importers take foreign exchange out. Okay, so exporters, they will receive the foreign exchange and they will give to bank. Banks will trade amongst themselves, and eventually, at some point, usually an importer will take foreign exchange out of the country. Right? In between, the central bank might intervene in the market. So if there is a surplus, there can either be a surplus or a deficit. Now, if there's a surplus, you have a trade surplus. If there's a deficit, you're running a trade deficit. Countries like Japan, what do you think is best, to have a trade surplus or a deficit? Very interesting point. What do you think is best? Yeah. What are your thoughts? What do you think is best? Yeah. Do you think it's good to have a trade surplus or a deficit? Which is better? Is it good to have a trade surplus or a deficit? Well, either way is okay, for as long as market forces prevail. Right now, in Japan, you have a continuing trade surplus, and that means the exports are more than imports. So the currency trend tends to appreciate quite a lot. Right? Now, when the currency, the local currency appreciates, it makes exports expensive. Right? So countries with trade surplus normally tend to lose their competitive advantage. Right? So that is perhaps part of the reason why people now tend to buy maybe Chinese vehicles or Indian vehicles. Right? Vehicle market, you tend to go for alternative vehicles or even Korean vehicles, perhaps. Right? One reason is perhaps Japan may have lost their competitive edge due to a strong currency. Right? So that is the situation. Japanese government is selling yen in the market to artificially weaken the yen. Right? So when they weaken the yen, the trade would do much better. They'll have more and more exports. Whereas if you have a trade deficit and the chances are your currency will depreciate, right? And to keep the currency strong, if your currency depreciates, right? The problem is now you're importing, and if your currency depreciates, then the cost of imports will go up, right? So that leads to inflation. To control that, if the government is selling reserves and finding reserves is difficult, then there can be issues. So it's very important that you strike a balance. It has to be managed very carefully. All right. Okay, so going back to market participants, you have banks who play a crucial role as intermediaries. Brokers, right, they bridge the gap between the short and the long, or those who have surplus or deficits. Investors and speculators, right? So if you want to invest overseas, if you are planning to expand overseas, now some of the banks, right, have overseas presence, have invested in overseas markets right now. Take, for example, a company like Commercial Bank or Bank of Ceylon, they have presence in foreign countries. Right? Most of the garment manufacturers locally have presence in other countries like in Bangladesh, Vietnam. For that, you need foreign exchange. Then speculators, those who trade based on currency fluctuations. Central banks, right? If they manage the country's reserves and all that, they also become participants. Give me a second, guys. There's something wrong with the set of slides. Hold on. Okay. So some of the fundamental terminology, right, in foreign exchange transactions. You perhaps may have come across this. Um, now these terms might sound odd or weird, but actually they mean quite very simple things, right? Now, for example, things like the trade date and the value date, right? Trade date means the transaction date, right? Now, in layman terms, it's something like this. Now, let's say you're single, not married, right? And you see the love of your life. So if you decide to get married on the same day, you see the person in the morning and decide to get married on the same day, right? The day you see the person is called trade date. The day you get married is called value date. Trade date and value date. Right? The day you see the person is trade date. The day you get married is value date. Okay. Trade date and value date. Right. Now, let's say you see the person this morning. You get married on the same day. That is called cash. Right? Cash. If you see the person today, you get married tomorrow, it is called Tom. You see the person today, get married 2 days after, it is called spot. Cash, Tom, spot. Anything beyond the spot date is called a forward. Right? So trade date is the transaction date. When you enter the transaction, the day you see the love of your life. And the day you get married is called settlement date. Trade date and settlement date. Okay, so there are 4 different trade settlement dates: cash, Tom, spot, forward. These are the settlement dates. Spot means, cash means same day. Like you see the person in the morning, get married on the same day, it's called cash. Tom means you see it today, so you see the person today, get married tomorrow. Spot, you see the person today, get married in 2 days. Forward, anything beyond 2 days is called forward. see and getting married on the same day, right? The day you see is called trade day. The day you get married is called wedding day. Okay. Any questions up to now? Well, the problem I have is some of the slides are missing. So let me see whether everything is in order. Hold on. Give me a second, guys. Let me just check. Well, let's continue with this, otherwise it will take a lot of time. Anyway, now let's assume that you go to a supermarket, right, to buy mangoes. When you go to the supermarket and you see the price of a mango is 100 rupees, now is the supermarket quoting the price to you, or are you quoting the price to supermarket? How does it happen? How does it work? Usually, do you quote the price to the supermarket, or does the supermarket quote the price to you? Yeah, the supermarket quotes the price to you, right? So the supermarket is called the market maker or the quoter. And you are the person asking the price from the supermarket. You are the market maker or the asker. The market maker and the market taker. There is always two parties to a transaction. One will be quoting the rate, the other one will be taking the rate, right? So you are the market maker and the market taker. Clear? Okay. Right. Exchange rate is the value of one unit of a currency in terms of another currency. Right. So how much is, forget about currencies, you take a mango. Right. How much is one mango in rupees? 100 rupees. That means one mango is worth 100 rupees. Right. So instead of mangoes, if you put dollars, then $1 is 100 rupees. So in this case, $1, 132.50 rupees. Now there are two currencies. Always in an exchange rate, you will come across two currencies. Not only exchange rate, anything in life, you will come across two currencies, right? Now the pen, price of this pen in terms of rupees, right? One pen is 100 rupees. So one pen, 200 rupees. And that's an exchange rate. So you, instead of using a pen, you can use a currency. Now, if you say one pen, or let's say one mango, 100 rupees. This is the price of a mango in terms of rupees. The price of one mango in terms of rupees. Right. You can write it as the exchange rate of a mango against rupees. 100. Okay, so the currency that you write first is called the base currency, and the currency that you write second is called the counter currency. Instead of writing mango, you can write dollars. Whatever you write first is called base. What you write second is called counter. If I may ask you a question, which of these currencies is stronger? What is your answer? Which of the currencies is stronger?
Dollar.
Why do you say dollar is strong? Yeah. Why do you say dollar is strong? Because it's 100. But what if I put something like this? Which currency is strong?
Singapore dollar?
Why?
Because 1.02 Canadian dollars needs for 1 Singapore dollar.
Okay. So how do you know which currency is strong? The key is this exchange rate. Right? If the exchange rate is more than 1, okay, the exchange rate is more than 1, it means the base currency is strong. And if the base currency is less than 1, the base currency is weak. Okay, that is the key. So if I give you an exchange rate like this, let's say A against B, right, is 2.1. Which currency is strong, A or B?
A.
Why?
Exchange rate is more than 1.
Yeah. Very good. Understood? Any questions? And if this was less than 1, which currency is stronger?
B.
Yeah. Okay, very simple. Right? You don't have to look at anything else, just look at the exchange rate. If it's more than 1, base currency strong, less than 1, base currency weak. Okay, any questions up to now? Right. So let's go to this one. Exchange rate between two currencies, the price of a base currency expressed in the units of quoted currency, right? So if you say one mango is 100 rupees, it means the price of one mango in terms of rupees. So if you say likewise one sterling is 300 rupees, it means the price of a sterling in terms of rupees. So in this case, Singapore dollar to Canadian is 1.02. One Singapore dollar is 1.02 Canadian dollars. Right. When you watch financial news, right, and if you see the exchange rate is 200, yeah. So if you say that the exchange rate is 200, this is the price of $1 in terms of rupees. Yeah. So you are giving now dollar is the foreign currency for us now. Rupee is the local currency, right? This is the price of $1 in terms of rupees, or in other words, the price of one foreign currency in terms of local currency. That's called a direct quote. You give the price of one foreign currency in terms of local currency, called a direct quote. You can also have the price of, what if you quote something like this, LKR to US dollar. Can you quote this? If I say it is 0.005, is this right or wrong? The quote is right or wrong?
Right.
Yeah, it's correct. No? Now we are quoting one local currency in terms of foreign currency. That's called indirect quote. Right? This is direct. This is indirect. But in practice, if you write the dollar first, it's called a direct quote. And if you write the dollar second, it's called indirect quote. And that's how it works in practice. Right? So direct quote is the number of domestic currency units per foreign currency. Indirect quote is number of foreign currency units per domestic currency unit. Right? All right. And the first theory in foreign exchange is called purchasing power parity. Purchasing power parity. Okay. What it means is very simple. Now let's say you go to McDonald's, right? McDonald's and you buy the Big Mac. Let's assume the price is 1,000 rupees. Then you go to US and you see McDonald's. You say Lanka with, you run to McDonald's, you buy a Big Mac, they will say $5. And in US, in Sri Lanka, in US, a Big Mac, it costs you 5. Right? So what purchasing power parity says is that the identical product, right? The same Big Mac, same size, same width, same taste, everything is the same quality. The price of the same product in two different markets will reflect the exchange rate between the currencies. Price of the same product in two different markets, Sri Lanka and US, reflects the exchange rate between the currencies. Right? So based on this price, the exchange rate of the US dollar against rupee should be 1,000 divided by 5, 200. That is purchasing power parity. Clear? Any questions? Any questions? No questions? Did you all understand purchasing power parity? But it may not work. It may not hold all the time. Why? Why do you think purchasing power parity may not be valid all the time? For what reasons? Why may it not be applicable sometimes or most of the time? Why not? Yeah, any reasons? Why do you think this might not be applicable all the time? For what reasons?
Demand and supply of Big Mac.
Yeah, demand and supply. Okay. So what happens now in between? Right? When you bring the Big Mac into Sri Lanka, there might be taxes, isn't it? You might get taxed. Then there could be transaction costs. Things like freight charges, storage costs, all that adds up. For these reasons, purchasing power parity may not apply. But in theory, it's fantastic. Understood? So let's go through this example. A chocolate bar that sells for 150 Canadian dollars in Canada should cost $1 in the US when the exchange rate between Canada and US is 1.5, right? So if it costs $1 in US, it should cost 1.5 in Canada if the exchange rate is 1.5, right? For the reason that we just discussed. Right, interest rate parity will come back later. Let's try these examples, right, using exchange rates in calculations. Right, shall we try them? So first one, given the exchange rate of 132, if you have $10 million, how much will you get in rupees? Very simple question. Right. The exchange rate given is 132. That means $1 is 132 rupees. So $10 million, therefore, will be 132 into 10 million, 1,320 million. Right? Any questions on this? You have 100 million rupees. How much can you get in dollars? What do you think? Should it be less than 100 million rupees, 100 million, or well, the dollar amount I mean should be less than 100 million or more than 100 million? Will it be less than 100 million or more than 100 million?
Less than.
Yeah. Very good. Right, so we'll go by the fundamental principle. $1 is 132 rupees. So what if I say 132 rupees is equal to $1? Is this right or wrong?
Right.
It's correct. Which means 1 rupee is 1 over 132. Therefore, you have 100 million rupees is 100 million divided by 132 dollars. So you get the answer. Any questions up now? Okay, so let's go to the second question. Given exchange rate of euro sterling, sorry, the same question, dollar rupee 132. What is the base currency? Now, these are the important things. If you understand these steps, you understand the entire thing. What is the base currency?
Euro.
US dollar. Counter currency? Counter currency?
LKR.
Yeah. Which currency is stronger?
Base currency is stronger.
Why do you say so?
More than one.
Okay, question number 2. Euro sterling. What is the base currency?
Euro.
Euro.
Which currency is stronger?
GBP.
Reason?
Exchange rate is below 1%.
Yeah, good. The dollar rupee example, direct or indirect?
Direct.
Yes. How about this? Direct or indirect? Euro sterling?
Indirect.
Indirect.
Indirect. Why?
Local currency is not involved.
Okay. So if the local currency is not involved at all, it's called a cross rate. Right? It's neither a direct quote nor an indirect quote, because the local currency is completely not out of it. No. If the local currency is completely out, it's called a cross rate. So this is a cross rate where the local currency does not appear. So if you say sterling US dollar for Sri Lanka, it is a cross rate. Why? The rupee is not there. Right? For Sri Lankan, it is a cross rate. I'm telling technically. But for an American, it is a direct quote for an American. Why? It's one unit of foreign currency in terms of local currency. Then for a guy in UK, it is an indirect quote. Right? It is one local currency in terms of foreign currency. Okay, so understand the difference. But in practice, this is a indirect quote. Right. So back to the question. Exchange rate, euro sterling 85.85. If you have 10 million euros, how much can you get in sterling? So 1 euro is 0.8585 sterling. €10 million is 0.8585 into 10 million. That's 8.585 million sterling. Okay. Next question. If you have 10 million sterling, how much can you get in euros? So if you have 0.8585 sterling, you will get 1 euro. Right? So 1 sterling, you get it 1 over 0.8585 euro. You have 10 million sterling. $10 million divided by 0.8585. Clear? Any questions? No questions. Let's try the next one. Currency movements. The exchange rate of dollar rupee goes from 132.20 to 132. What has happened? Can you all figure that out? Let's take the price of a mango. Yesterday, let's say it was 100 rupees. And today, it is 120 rupees. What has happened? Has the price of a mango or the mango strength gained in value or lost value?
Gain in value?
Gained. Why is that? Is the price has gone up or down?
Gone up.
Gone up. Right. Now this is the price of one mango in rupees. Now what is the base currency? Base currency is what is the base?
Mango.
Mango is the base currency, right? And when the price goes up, it means the base is strengthening, right? But by any chance, if the price had gone to 80, might not happen in Sri Lanka because in Sri Lanka the prices never come down, they only go up. But if the price had dropped to 80, then what happened? The price of a mango, the value of a mango has gone up or gone down? Yeah. Gone up or gone down now?
Gone down.
Gone down. Which means if the price goes up, the base currency is strengthening, the price goes down, the base currency is weakening. Right? So this example, $rupee 132.20. Sorry, the mango example once again. If the price drops to 80, that is a drop of 20 rupees now. Started at 100 percentage, 20% drop. Okay. On the other hand, if it had gone up to let's say 140, that is a 40 rupee increase. Percentage is 40%. Okay, so can you calculate? Look at this example. 132.20 drops to 132. So as the dollar strengthened or weakened. Now in this example, mango price 100 to 80. The mango has weakened. But if the mango price goes from 100 to 140, the mango has strengthened. And so instead of mango, if you put dollar, if the dollar goes from 132.20 to 132, would it have strengthened or weakened? Yeah, 130 to 20. If it drops to 132, which currency has strengthened? Which currency has the base currency strengthened or weakened?
Base currency weakened.
Base currency weakens. 132.20. If it goes to 132, that means the dollar weakened by what percentage? That's a 20-cent drop now. Divided by starting price 132.20. That will give the percentage change. Right? By 0.15%. Question number 2. Sterling dollar 152.50 gone to 152. Right? So what has happened? The price has gone down, meaning the base currency has strengthened or weakened. Yeah.
US dollar has strengthened.
Yeah, sterling has weakened, right? That's 50 basis point drop. This gives you the percentage change. Right? Any questions? Questions? No questions? Okay. Right. Again, the supermarket and mango example, right? If you want to buy a mango, right, you go to the supermarket, you might pay, let's assume 100 rupees to buy a mango. Right. And if you have a mango plantation, you try to sell mangoes to this supermarket, the same supermarket, will they buy mangoes at a price more than 100 or less than 100?
Less than 100.
Yeah. So they will buy mangoes at maybe 90 bucks. Right? So the supermarket will buy a mango at 90 and they will sell a mango at 100. Now, what is the base in this case? Mango or rupee? What is the base?
Mango.
Mango is the base, right? So the supermarket will buy the base at a low price and they will sell the base at a higher price. Now, the price at which they will buy the base is called the bid, right? And the price at which they will sell the base is called the offer, bid and offer. Okay. Now, what is the profit that the supermarket will make by selling mangoes? What is the profit?
10.
10. How do you get profit?
Difference between bid and offer.
Yeah, it's actually the offer minus the bid, correct? Which is 10. That is called the spread. Okay, so the spread represents the profit to whom? The supermarket or to the customer. To the supermarket or to the customer. Yeah, the profit is made by the supermarket or the customer.
Supermarket.
By the supermarket. The supermarket makes the profit. The supermarket is what? The market maker or the taker? Market maker or the taker?
Maker.
Market maker. And the customer is the market taker. So this profit is for the market maker. And the spread represents the profit for the market maker. Clear? Any questions? Right. Now, when exchange rates are quoted, what is quoted is always the last two digits. Last two digits. That is what is always quoted. Okay. So let's say US dollar rupee is quoted at 203.30, 203.40. What is the bid in this example? Bid what would be the bid?
$203.30.
203.30 is the bid, correct. And the offer? Offer?
0.40.
Yeah. This is the bid, and this is the offer. When you quote exchange rates, what you always quote, what is quoted in the market is usually the last two digits. Right? So the quote will be 30, 40. Now these last two digits are called pips. They're called pips. And the number that comes in front is called the big figure. Okay. Clear? Any questions? By the way, in the example that is given, remember pips are the last two digits. Now, on this example that is given, euro dollar given as 132.75. Right? So the last two digits are 75. They are the pips. Big figure is 1.32. Right? So what's quoted in the market will be the pips. Right? So let's go through this conversation. Now what is given in the conversation is a foreign exchange transaction. Right? Now, if you go to a bank and you want to deposit or withdraw, let's say 100 rupees, you have to fill a form, you have to sign it, you have to give it to the cashier. The cashier will get the approval from his authorizing officer. Right? It's a big process, no? But in treasury, right, when you do transactions of millions of dollars, all that is done and concluded, everything is done and concluded on a simple chat screen that you can see now. Right? And this takes less than a minute. The entire conversation takes less than a minute. Right? So let's just go through it. You may notice that there are two colors, black and blue. Right? So these represent two traders. Black given below as Nalika, and blue color is a guy called Sven. Right? So Nalika prompts Sven's bank and asks for AUD 5 million. Now, what does that mean? AUD 5 million. What does it mean? What she's actually asking is the code for Australian dollar against US dollar. Right? Australian dollar against US dollar. Amount is 5 million. Sven replies saying 1517. So why is Sven giving 1517? What does that mean? What is he quoting? He's quoting the pips. Remember the last two digits. Right? So Sven has quoted the pips. Now, how do you know what should come in front? In other words, what should be the big figure? How would that be known? Well, the answer is, if you are a participant in the market, you should know what the big figure is. Right? You should know where the market is. Right? So Sven answers and says 1517. Nalika says, I buy. She's buying what? The base currency. Right? Australia, US dollar, now the quote, AUD, US dollar. So the base currency she's buying. She will buy the base currency. Remember the mango example, at the higher rate. You buy mangoes, remember, at the higher price or the offer. So Nalika is the market taker. She will buy Australian dollars at the higher price, which is 17. So let's go to the next one. Then Sven says JP Morgan Chase, New York, and gives the account details and mentions the value date, 31st January 2011. Now, see, when Nalika buys Australian dollars, she is selling US dollars, right? So Sven is selling Australian dollars and he's buying US dollars, right? So Sven will receive US dollars, which has to be transferred to his Nostro account, which is in JP Morgan Chase, and it has to be credited on 31st January. Right? Now, Nalika is buying Australian dollars, right? So her Australian dollars have to be transferred to her Nostro account in Australia, which is what she's given below. She says to confirm at 0.9917, right? Now she tells the exchange rate. Big figure is 0.99. 17, remember, is the pips. I buy 5 million Australian dollars. Value date 31st January. My Australian dollars to Reserve Bank of Australia. Right? So she wants Australian dollars to be transferred to the Reserve Bank of Australia. That's it. It takes less than a minute to conclude this transaction. Any questions on that? No questions? Okay, so let's move on. Let's do these examples. Let's try these examples. First question. $Rupee 132.50, 134.74. What is the base currency? Yeah, what's the base currency? Yeah. What is the base currency?
USD.
US dollar, right? The currency that is written first is the base. Dollar is the base. Big. Big.
132.50.
132.50 is the bid. Offer is 134.74. Right. So question number 2. $yen 102.90.95. At what rate can you buy dollars? What rate can you sell yen? What rate can you sell dollars? Okay. So let's try and answer that. What trade can you buy dollars? What do you think? What trade can you buy dollars? Okay, it's given us 102.90.95. Okay. So what it actually means is it's 102.90, and remember these are in pips. Huh? If you write it expanded version, it's 102.90 and 102.95. We cannot. At what rate can you buy dollars? What do you think? The good thing about foreign exchange is there is always a 50% chance of success. Only two rates. So you say 102.90 or 102.95. 50-50. What do you think? But only thing is, if you make a mistake, you will make losses. Right? So you can't afford to make mistakes. Remember, foreign exchange transactions, the size of a foreign exchange transaction is massive. Yeah, at what rate would you buy dollars? Take a guess. Hello. What do you think? Now, just forget that this is a currency. Let's say this is the prices of, these are the prices of mangoes. Right? Mango and rupee. What is the base? Sorry, what price can you buy mangoes now? At what price will you buy mangoes? At what price can you buy mangoes? Well, remember the supermarket example. If you go to the supermarket and you buy mangoes, you'll have to buy the lower price or the higher price.
Low price.
You will buy the low price. Remember the supermarket example? No? If you want to buy mangoes, you buy at which price? Lower price or the higher price?
Lower price.
Okay.
Supermarket will get the mangoes at a lower price, but we have to pay a higher price to get the mangoes.
Exactly. Right. You have to buy at the offer, no? And the supermarket will be selling mangoes at the higher price. They will be buying it at the lower price. Right. So you will be buying at the offer or the higher price, isn't it? Understood? Right? Okay. Yeah. Yeah. So you'll have to pay the higher price. Eh? Now, if this was the mango price of a mango, you'll be buying mangoes at what price? Hmm? At what price will you buy mangoes? 102.90 or 102.95?
102.95.
102.95. Isn't it? Okay. Right. So if this was the mango was dollars, right? Mango is dollars and rupee is the yen. At what price will you buy mangoes? Same concept. 90 or 95? $90 or 95? You'll have to buy it. Hello. And 295. Okay, so if you all are not responding, I'll just continue. I'll assume that you all understand everything I say. Right. You'll have to buy mangoes, buy dollars at 102.95. Okay, it's like similar to buying mangoes. You'll have to buy dollars at 102.95. The next question is, at what rate can you sell yen? Right, you sell yen. If you think in terms of mangoes, right? Remember, you're the market taker. If you're selling yen, that means you're buying mangoes. You can buy mangoes 102.95. So you can sell yen also at 102.95. At what rate can you sell dollars? Right. Remember, you can sell mangoes at the bid. So you can sell dollars at the bid 102.90. Right? Clear? Okay. And when you answer foreign exchange questions, there are a few steps which you have to follow. If you follow these steps, you will never make a mistake. Step 1 is identify base currency. Then assume you're the market taker. You always assume you're the market taker unless it is specifically given that you are the market maker. Right? And figure out what is being done to the base. Are you buying the base or selling the base? The next step is sell base at the bid, and you can buy the base at the offer. Sell the base at the bid, buy the base at the offer. This is all you need to know. If you follow these steps, you will never make a mistake. Right? So if you go back to the questions, at what rate can you buy dollars? Base currency is the dollar. You are the market taker. Dollars you have to buy, right? So you are buying the base. You're buying the base currency. You buy the base currency at the offer, 102.95. Then what rate can you sell yen? Selling yen means base you have to buy. If you sell the yen, you have to buy the base. You can buy the base at the offer, 102.95. Then what rate can you sell dollars? Very straightforward. You sell the base at the bid, 102.90. Question number 2. $153.25 25 and 153.30. At what rate can you buy dollars? Step 1 is to identify the base currency. I'll stick to these steps and try to find out the answers. What rate can you buy dollars? So base currency is the sterling. Buying dollars means you're selling sterling. Selling sterling at 153.25 the bid. You sell sterling at the bid. What rate can you buy sterling? Sterling is the base currency. You can buy the base at the offer. Right? So you'll be buying sterling at 153.30. What rate can you sell dollars? If you sell dollars, you'll be buying sterling. You'll be buying sterling at the offer. 153.30. Next question. Euro dollar. One 10.15. What rate can you buy dollar? Right. So base currency is the euro. Buying dollars means you're selling the base. You'll be selling the base at the bid 130. Right. And what rate can you buy euro? Very straightforward. You will be buying the base at the offer 130.15. What rate can you sell dollars? Sell dollars means you're buying the base at the offer 130.15. So far, okay. Right, so let's move on to the next one. You have been given two exchange rates. Dollar yen. And 150.55, right? So you have been, remember, given the pips, meaning this has to be 101.50 and 101.55. Then euro dollar. $131.75, 80, and this 131.75, 131.80. So what rate? Q stands for quarter, A is the ask. Quota is the market maker. Is the asker of the market taker. Question number 1. What rate the quota on market maker sells dollars on dollar yen? Like dollar yen. It's like the supermarket selling mangoes. Right? They'll sell at the offer, right? 101.55. What rate the quota buys yen on dollar yen? Right, so buying yen means, again, the supermarket, it's like the supermarket buying rupees and selling mangoes. Right, again, at the high rate of the offer, 101.55. Third one, what rate the asker buys dollars on dollar yen? And you are buying mangoes at the higher rate of the offer, 101.55. Number 4, what rate the asker sells dollars on euro dollar? Right, now you are the market taker, euro dollar base currency is euro. Selling dollars means you have to buy euro, right? At the offer. Number 5. At what rate the asker sells euro on euro dollar? Right. So selling euro on euro dollar is 131.75. What rate the quoter buys dollars on euro dollar? The quoter buying dollars, meaning he's selling the base or selling mangoes at the high price of the offer, 131.80. What rate the quoter sells dollars on dollar yen? Sorry, what rate the quoter sells yen on dollar yen? Selling yen means he's buying dollars. At 101.50. Question number 8. What rate the asker sells dollars on dollar yen? Right. So you sell the base at the bid, which is 101. Any questions up to now? Right. So now let's say you're selling mangoes. You are selling mangoes. Right. You're a mango trader. You buy and sell mangoes. Now let's say on assume yesterday, 18th October, your opening balance of mangoes. Let us assume a 0. And you had no mangoes at the beginning. Then during the day, you bought 100 mangoes, 100 rupees each. Right? Mangoes you're buying, that means you're receiving mangoes. And to buy mangoes, you have to give your rupees. And so rupees are going out. And so let's say this is, let's indicate the outflow by minus. And you are getting mangoes, and you are giving away the rupees. Right. Then let's say you bought a further 200 mangoes at a price of 8 rupees each. Right. So there will be an outflow this time of 16,000 rupees. Now let's assume the closing balance of your mangoes. Not assume, let's see what the closing balance is. You have 300 mangoes which you have purchased, and the total rupee outflow is 26,000. Right? Meaning the average price of a mango would be 26,000 divided by 300. $86.67. Okay. Clear up to now? Now, what will happen if the closing price of a mango, right, on 18th October, if the closing price is 120, right? If the closing price is 120, would you have made a profit or a loss? Would you make a profit or a loss if the closing price is 120?
Profit?
Yes, you will make a profit. Of how much? .
120 minus 86.
Yeah, into 300. No? So how you arrive at the profit is you assume you are selling the entire lot of mangoes, right? At 120. So you sell your mangoes. When you sell mangoes, you receive rupees. So that's an inflow of rupees 36,000. Right. So eventually, you end up with 0 mangoes, but rupees you have 10,000. 10,000 rupees. Right. Meaning you end up with a profit of 10,000 bucks. Okay, that's how you calculate your profits. Understood? Right. Sorry, one more thing. Now this is if the price of a mango is 120. But what if the price of a mango is not 120? It goes to 75. Will you make a profit or a loss? Price of a mango is 75. Would you make a profit or a loss?
Loss.
Yeah. Again, you assume you're selling the entire lot of mangoes at a price of 75. So when you sell 300 mangoes, you will receive 22,500 rupees. Right? So the net 0 here, and here will be 3,500 minus. You will end up with a loss of 3,500. Isn't it? Right. So if the price, you would have observed that if the price goes up, you will make a profit, but if the price goes down, you will make a loss. Okay. Right. So if you have 300 mangoes, what is your risk? The price going up is a risk or the price going down is a risk?
Price going up.
Price going down is a risk. Right. Right. Now let's assume that you have sold entire lot of mangoes, right? Not a single mango with you. Now what is the risk? The price going up is a risk or price going down is a risk? What happens if you have profit if the price goes up after you sell all of your mangoes? Or let's say you're not into mango business at all, right? You're not into mango business. You don't like mangoes at all. What is the impact on you if the price changes? If it goes up, what happens? If it goes down, the price of mango goes down, what happens? Yeah. there is no impact. No. Because if you are not in the mango business, you don't buy mangoes, you don't sell mangoes, nothing. And you don't like mangoes. If the price of a mango goes up or if it goes down, there is no impact on it. Because you have no exposure. Right? But if you have 300 mangoes with you and the price goes down, you will lose. Right? So if you have no exposure, there is no price risk. But if you have bought 300 mangoes, or if you have bought mangoes and the price goes down, you will lose. Likewise, what will happen if, let's say, something like this. Oh, by the way, in this case, you have 300 mangoes with you. Your risk is the price going down, right? So this is called overbought. Right? If you are overbought, the risk is the price going down. Okay, so this was on 18th October. 19th October, let's say you got an order, right, to sell 500 mangoes. Right, you agreed to sell 500 mangoes, you have only 300. And let's say you agreed to sell at a price of 100. Right. So you will receive 50,000 bucks. And if you take the net, you're short of 200 mangoes and you will have 24,000 rupees. Right. So now you have promised to deliver 500 mangoes, but you have only 300 and you have to buy back the balance 200. My question is, you will lose money if the price of a mango goes above what price? You will lose money if the price of a mango goes above what? You will lose money. Price of a mango goes above. What do you think? You will lose money if the price of a mango goes above what price? See, you need to buy that 200 rupees and 200 mangoes, and you have 24,000 bucks left. Right? 24,000 divided by 200 is price of 120. Right? So if the price, let's say, of a mango goes up to 150, then you will have to end up buying 200 mangoes at a price of 150. You will have to spend 30,000 bucks. You will make a loss of 6,000. Right. But if the price of a mango, let's say, drops to 80, you will spend 16,000 bucks to purchase mangoes, and you will be left with 8,000. Okay. Now the next point I need to make is, see, if you are plus, it's overbought. The risk is the price going down. Likewise, if you're minus, it's called oversold or short. You're overbought or long. And the risk, if you're short, the price going up. Okay. Any questions on that? Questions? Right. Sorry. The next thing is, see, when you're long, the risk is the price going down. When you're short, the risk is the price going up. Right? So these exposures are called positions. So exposures are called positions. Understood? Any questions? A position is where traders, sorry, we can skip that, we have already discussed. Right. Okay. One more thing which I could not mention. You have long, short. Also, you can end up with zero. This is called square position. Right. When you are square, the amount you are left with in terms of counter currency. Remember, the base is mango, counter currency rupees. When you're spread on mangoes, you'll be left with your profit in counter currency. You're left with profit in counter currency. I hope that is clear. Right, so let's try this example. At 8 o'clock, the sterling rate was 158.50, and at 8:05, the sterling rate is 158.70. Now my question is, for you to make a profit, should you have bought at 8 or sold at 8? At 8 o'clock. What should you have done? If you are to make a profit, what should you have done? So let's do it. Sterling and dollars, right? At 8 o'clock, if you had bought 1 million sterling at 158.50, you would have sold, you would have saved 158.50 million dollars, right? Then at 8:05, if the rate had gone up to 158.70, right, to square off, you should have sold 1 million sterling, and when you sell 1 million sterling at 158.70, you will receive 1.5870 million dollars. So if you total this up, it comes to 0, and here will be, you will be left with $2,000 profit. You'll be left with a $2,000 profit. Understood? Okay, now what if you had done the opposite? Instead of buying, if you had sold, and instead of buying, if you had sold, say you had sold 1 million sterling at 80 block. You will receive 1.58 million dollars. Now to square off, if you bought it back 5 minutes later, you will be selling 1.5870 million dollars. Then the loss of $2,000. Any questions? All right. So let's try this example. Calculating average cost. Right, remember the mango calculation? We calculated average cost of the mango. Same thing applies. Sterling and dollars. You buy 5 million sterling. $155.10. When you buy 5 million sterling, you will sell Seven. $7.755 million. Then you buy 10 million sterling. 155.60. And by 5 million at 155.40. The total amount is 20 million sterling and dollars. Dollars will be short of 31.085 million. So the average cost would be 31.085 million divided by 20 million. Okay. Any questions? Right. So let's do the next one. By the way, now are you long or short? Sterling, you're long or short? Are you long sterling or short sterling? Hello? This is your long sterling or short sterling? Yeah. In other words, you're overbought or oversold in sterling. Yeah, overbought or oversold. Any idea? Are you long or short? If your plus means you're long, if you're long, the risk is the price coming down. Right? So if the price drops below 155.42, you will lose. I wish you had given the answer. The reason I ask questions is so that you get used to for the exam. Right? If you make mistakes now, it's a blessing, so that you will be better prepared for the exam. So if you want, you can answer. It's up to you. Right? Let's do the next area. Next question. It's about average cost of profit calculation. Buy 5 million Australian dollars and 93.40. Then you buy 10 million Australian dollars. 93.25. You buy 5 million Australian dollars again. $93.55. And you sell 10 million Australian dollars at 93.10. You buy Australian dollars means you are selling US dollars. And each of these three instances, you have bought Australian dollars, you run short of US dollars. Then you are selling 10 million Australian dollars. When you sell Australian, you get US. Okay, 95310. Sorry, it's not minus, it is plus because you are selling Aussie. If you total it out, you get plus 10 million Australian dollars. And US side, so your average cost $0.9365. Now, are you long Australian or short Australian dollars? Australian dollars, are you long or short? And what is your risk? The exchange rate going up is the risk, or the rate going down is the risk? You all are long Australian dollars or short Australian dollars? And what is the risk? It's very easy. If you're plus, that means you're long, minus means you're short. So you're long Australian dollars. And your risk is, if you're long, the risk is exchange rate going down. Remember what we discussed earlier? The rate goes down below 0.9365, you will lose. And if it goes up, you will make a profit. Understood? Any questions? It says the Aussie dollar closing is 93.89. You are long 10 million Australian, and square off you need to sell. Square at 93.89. When you sell Australian dollars, you will receive US dollars. So you make a profit of 26,500. If you end up with a profit of 26,500. Now this profit is made in which currency? Australian dollars or in US dollars? Australian dollars or US dollars?
In Australian dollar?
No. See your Australian dollars, you end up with zero now. That's a Australian dollar, end of story. Right? The profit comes in US dollars. Right? Remember, your profit always comes in the counter currency. Understood?
Yes.
So you make a profit of 26,500 US dollars. Okay. Clear? Okay, so looks like we have run out of time. All right, guys, so let's wind up for today, and I will see you once again on Sunday, 3:30, same time. All right, thank you very much. Stay safe.